Most investors completely misunderstand why this company makes money.
They're all looking at revenue and return on capital employed, and yeah, those numbers look incredible. But the real power, the real story, it's hidden somewhere else.
And what? If you don't get this one part, you'll never really know. Is this stock going to compound for you, or is it just going to quietly break?
See, the hardest part of this business, it's not about winning big orders. It's about converting the revenue you've booked on paper into actual cold, hard cash in the bank.
That's why their margins are so fragile. That's why project execution is absolutely everything. And that's why, at the end of the day, cash is the only truth.
Now, here's what could still absolutely break this business. But, and this is the interesting part, here's why it probably won't. And stick around, because I am going to tell you my final decision at the very end.
All right, so before we get into the really deep risks, you have to understand the temptation. You have to see why everyone is so excited. And let me tell you, the growth story for this company, Waaree Renewables, is, well, it's incredibly tempting.
Okay, just look at this. This is what's got Wall Street buzzing. The profit after taxes just exploded, going from a tiny 2 crores to almost 230 crores in just 4 years. That's not just growth, that's a rocket launch. This is the kind of chart that makes people rich, and it's why you're probably hearing about this stock everywhere.
And then you see this number, an 81.8% return on capital employed. I mean, are you kidding me? For a business that actually builds things, a number like that is just, it's wild. It's almost unheard of. On the surface, it looks like an absolute money printing machine. But is it the real deal?
So to figure that out, we have to look past these shiny numbers and ask a really simple question. What does Waaree actually do? This is where we start peeling back the first layer of the onion.
Okay, this is absolutely crucial, so listen up. Waaree Renewables is not a solar panel maker. That's a totally different part of the Waaree Group. This company is what we call an EPC company, engineering, procurement, and construction. They don't make the parts. They're the ones on the ground, managing the incredibly complex job of building the actual solar power plants. It's a project business, not a factory business. And that difference, it changes everything.
And that right there brings us to the uncomfortable truth. This is the single biggest risk that I believe the market is completely ignoring. You see, in a project business like this, the connection between the profit you see on paper and the cash in your bank account, it gets very, very messy.
I want you to burn this into your brain. This is where your investment either lives or dies. Because in the EPC game, only one thing survives: cash. Profits can be an illusion. Cash is the only thing that's real.
So here's the trap. An EPC company can say, hey, we hit a milestone on this project, so we're booking a profit, long before the client ever actually cuts them a check. You see the problem? That amazing profit growth we saw, that's an opinion. The money that's actually in the bank, that's a fact. And right now, the opinion is running way, way ahead of the fact.
And you can see the signs of stress if you know where to look. These are the yellow flags waving right at you. First, their receivables. That's the pile of IOUs from their customers are growing even faster than their insane revenue growth. That's a huge warning sign. And second, the actual cash they're generating from operations is lagging way behind that beautiful profit number. That gap, that's where all the risk is hiding.
So if the business itself is naturally risky, what do we look at? We have to look at the people, the management. Do they have the discipline to handle this cash flow tightrope walk? And here's the kicker. The real test for this team, it hasn't even happened yet.
And this is probably the single most important question you need to ask yourself as an investor. This stock has been on an absolute tear. It's never really had a bad quarter where things go sideways. So what happens when that day finally comes? How will management react? Because their reaction is going to tell you everything you need to know.
So here's your playbook. This is what you need to watch for. When that first bad quarter inevitably hits, you need to listen very, very carefully. If management gets on the earnings call and starts talking about execution problems, about project delays, and most importantly, about collecting cash, that's a good sign. That shows discipline. But if they start blaming temporary macro headwinds and try to distract you with shiny new orders they've just won, that is a massive warning sign. That is the language of a company that could be in real trouble.
So, okay, we've got this high-growth, high-risk business and a management team that's still untested in a crisis. So, how is the market pricing all of this in? Let's talk valuation. Right now, at its current price, the market is basically betting on a fairy tale. It's pricing this stock as if they'll keep winning huge projects, their margins will stay sky high, and this whole working capital stress thing, it'll just magically fix itself. There is zero room for error priced into this stock today.
So let's be absolutely crystal clear about this. This stock is not cheap. Don't let a simple PE ratio fool you, because that's not the whole story. It's only fairly priced if, and this is a big if, management executes perfectly from this day forward. Any slip up and it could get ugly. This is a stock that will brutally punish complacency.
All right, so that brings us to the grand finale, the final decision. We get the story, we see the risks, we understand the price, so how do we put it all together? How do you actually deploy your capital here, if at all?
Now you might be thinking, with all these risks, why even bother? Well, because the good parts are really, really good. The tailwinds for the solar sector are undeniable. They are not going away. Being part of the bigger Waaree group gives them a huge advantage in getting materials. And here's the most important part. Their balance sheet right now is clean. They haven't loaded up on debt yet, so they have a fighting chance.
Because of that, there's only one sane way to invest here, with incredible discipline. You don't just jump in with both feet. You do it in phases. Think of it like this. Step 1 is probation. You put in maybe 30% of what you're willing to invest, just to get some skin in the game. Step 2 is confirmation. You add another 40%, but, and this is non-negotiable, only if you see that cash flow start to improve. If it doesn't, you stop right there. And step 3, conviction. The final 30% only goes in after they've gone through a tough quarter, and you've seen the management react with that discipline we talked about. That's how you play this game smartly.
So here's my final verdict. Today, I would invest here. But let me be very clear why. It's not because I'm just blindly betting on growth. I would invest because this is a disciplined asymmetry bet. The upside is massive if they pull it off. And our phased plan protects us on the downside. This company is not going to reward blind excitement. It's not going to reward hype. It is going to reward your discipline as an investor.